Hello, this is Dr. Janice Cito, and I'm the instructor for Accounting Grade 12. It's July 2015 here in beautiful sunny Subang Jaya. It's the CPU program, Canadian Pre-University program here at Taylor's College. All right, let's go. So we left off with looking at some of these review questions, and one that I've had a lot of questions about is question 13 of this one, and basically it's preparing a statement of cash flows. I'm given a lot of information from Lanus Medical Incorporation. They had some cash, and they made some money, and then they spent some money. And so what happened to cash flow? How do we prepare this cash flow statement? Miss Janice, I'm panicking. Well, okay, I'm here to help you with this. So first of all, let's take a look at the statement of cash flow. So remember on page 3031 is a end of chapter summative summary problem. And so you get to see how they did an income statement, which we've done, statement of changes in equity, which we've done, balance sheet, which we've done, and now the fourth financial statement is a statement of cash flow, which we haven't done, but you see it right here. So like anything in accounting, it's where's the money? Is it coming in? Is it going out? And what is it right now? And so, as you can see with the statement of cash flows, we could see that there's different areas in which a business brings money into its entity. It can come in through operating activities, it can come in through investing activities, and through financing activities. So, for example, you sell things, you sell products or services, that's operating activities. Another way in which a business can get money is you take your assets, you can sell it, or you can buy assets. So these are investing activities. And then financing is you get money, like you get loans, or you can disperse. Why do I bring in words like disperse? Or you can distribute profits in the form of dividends, or sometimes they call owner's drawing. Anyways, so this is what we have. So there's three areas that we can get money. So this becomes very important as we go and study. So let's figure out how we do it. Okay, so what I did was I gave you folks a spreadsheet. I put it on the the files of the Facebook account, and here it is. It's a cash flow statement. So all you have to do is take the figures in the question and just plug it into the right space. Now, I understand some people say, but Miss, this doesn't look exactly like this. All right, well then if it doesn't look exactly the way it is, then change it. So what I did, because I'm me, I took it. And then I looked it over, and I said, fine, what changes do I have to make? So what I did was I said, okay, it says the year ending, and according to what you have here, they don't have it, they have cash balance. So then I shifted things. So things I shifted around. And as you can see, this is a bit smaller than the one here, because this one here captures everything. So you take out what you don't need. You zero what you're not using. So what I did first was I changed it so it looks, so I've got here the cash balance at the beginning, at the end, etc., net increase in cash. So basically I zeroed everything, and I changed the dates, and I made sure the formulas work, and then I decided to plug in the numbers as necessary. So let's take a look at what are some of the numbers we need to plug in. Let's go back to S. Here we are. So it ended that year with cash of $25,000. So you've got to put in cash of $25,000. You put that right here, $25,000. And it also says we have net income of $95,000. So we put in net income of $95,000. What else do we have? Let's see. We had adjustments to reconcile net income to net cash provided by operations totaling $20,000, and which is a negative amount. So we've got to make sure that this is a minus. So 20,000. So if I've done the formula properly, this should, 90. So I've got to make it negative. There it is, 75. All right, let's see, what else do we have to do? Paid for equipment, 35, and then dividends of 15. All right, let's see, where is this? Equipment. So basically purchased equipment. So there's two categories for equipment. One is purchase and one is sale. So we purchased. So when we purchase, it should be negative because that's not money that's coming in, it's money that's going out. Right. And what else is there? Dividends. Dividends go out. So you began, so cash increased, 25. Add the cash balance at the end of the year, previous year, and so we've got 50. Let's take a look. Did we account for everything? Yes. So that's basically how you do your statement of cash flows. Let's see, what else can we do? There's a good question at the end, close to the end. I think it's page 51. Let's see if I can find it. Yes. This is analyzing the financial statements. So you've got your income statement, changes in equity, balance sheet, and also the cash flow. So why don't we just try our best? So this is 2006 and then 2007. So where you see A, B, C, etc., these are amounts that are, they're not given to you, but you can calculate them. And so let's try that, and then we'll input the numbers. You input the numbers, and then we'll see what happens at the end, and we'll see how well this company's doing. So we've done the statement of cash flows. This is something you folks can do on your own. And then we've got these two case studies, the decision cases, in which you're trying to decide, is this company worth investing in or not? So here in case one, you've got two companies. One's called Open Road, the other one's called Blue Skies. You only have the balance sheets to look at. So they've both come to you for loans, and you have to decide which one is preferable for you to invest in. So, there's no real right answer. It depends on your goal. Come to class, and then we'll go over it. The other one is it's Grand Prize Unlimited, and here are the financial statements, income statement, balance sheet. So only those two, and study them and just make a decision. Now here's the thing: you're going to have to redo them because it turns out these financial statements are not accurate. So we have to make some adjustments. And then based on the adjusted or the corrected financial statements, how are they doing? And is this something you want to invest in? So thank you very much, and we'll